I'm Rob Murphy, Head of Investment Trust at Edison, and I'm very pleased to be talking today with Simon Gergel, who's Manager of the Merchants Investment Trust. Welcome, Simon.
Hi, Rob.
What does Merchants offer investors in terms of both capital and income growth potential?
Well, Merchants Trust has an objective of delivering a high income and a good total return, good capital growth. We have grown the dividend for 40 years, and that's a really important objective of the trust. And we do that both by buying high yielding shares, but also by rotating the portfolio. If a company with a good yield performs well and the yield drops, we may sell it and invest in another company, which adds to the income. So we can grow the income both organically within the portfolio, but also by buying new companies with better yields. But that shouldn't take away from the other objective, which is capital and total return. And we only ever buy companies if we think we can make good money out of it, good return out of it. So we like to have a yield on a company when we buy it, but we're really thinking about making a good total return. And I'm pleased to say that over time we have delivered good returns as well.
And I mean, you're mostly a UK trust, but you also have some non-UK listed stocks. Could you maybe highlight why they're in there and what those are?
Yes, well, a couple of years ago, the board of directors, who are independently from us, they gave us the authority to invest overseas at a time when you was looking during the pandemic at quite a concentrated UK market. Many of the companies in the UK market had cut their dividends, and we were looking to diversify a little bit to both broaden the portfolios, to reduce the risk of an individual company, so give us a bigger number of companies we could buy, but also specifically to pick up both new ideas in sectors we like pharmaceuticals or energy, but also exposure to sectors that are hard to invest in the UK market, like reinsurance or automotive. So we've only got about 5 or 6% in there. We've got a limit of 10%, but it just gives us a little bit extra scope to diversify the portfolio and find new ideas.
You know, we've been in quite volatile times over the last couple of years. How would you describe the main features of the UK stock market so far this year?
Well, I think the overwhelming feature of probably all markets this year has been the rise in inflation. As we came into the year, we were already seeing some inflationary cost pressures in energy from supply chain disruption in Asia because of COVID. And then that was exacerbated tremendously by the Russian invasion of Ukraine. We saw a huge spike in gas price and energy prices. And inflation's gone up significantly. And in response to that, of course, central banks have now started to raise interest rates, and people have got a lot more nervous about the outlook. Investors have got a lot more cautious, partly because the cost of living is going up, the cost of goods are going up, but also the cost of money, inflation, interest rates have gone up. And therefore, the environment in the market has been much more cautious. You've seen that reflected in cyclical companies exposed to the economy performing worst in terms of share prices. They've been heavily derated. More defensive businesses in areas like utilities, food producers, those type of more safe and secure areas, those shares have performed very well. So you've seen quite a polarization in the market, with defensives holding up and cyclicals going down. That's probably been the major feature of the market this year.
So given that environment of increasing inflation expectations and higher interest rates, how has that affected how you position versus the benchmark?
Well, as you know, we're actually positioned very different to the benchmark. We have a very high what's called active share. How different the portfolio is around about 70% in the portfolio, which allows us to take a lot of quite strong views on individual companies. We've actually been adding to many of the sectors that are quite well protected from inflation. So we've been adding to sectors like house builders, where you've got real assets, land and houses that over time you'd hope go up with inflation. Real estate, companies like CLS, which is a small real estate company we've added to the portfolio. We've also got some big exposure in areas like utilities, where the regulatory framework allows the companies to pass on inflationary price increases to their customers. And so there's quite a few areas in the portfolio that are quite well protected from inflation. But when we're looking at new ideas, we're thinking about how they would perform in this type of environment. And that allows us hopefully to add some value over time.
And maybe you could comment on Merchants' performance in absolute and relative terms, and what's been driving that over the last couple of years?
Well, we've had strong performance, certainly relative to both the market and our competitors, our peer group. So far this year, the markets have been, as you know, pretty soggy. The UK has been one of the better markets, and so we are pretty flat, maybe down a little bit year to date in absolute terms, but we are ahead of where the all share index is, the benchmark is. But over 2 or 3 years or 4 or 5 years, we have performed very, very well in both absolute terms, but also relative to the market. What's been driving that? I think a number of things have driven that. Some of the big sector calls we've had, such as large exposure to the energy sector at the right time, avoiding some of the more expensive telecoms companies 2 or 3 years ago, avoiding some of the more expensive growth stocks a year ago. But also we've had some really good stock selection. We've had about 3 or 4 companies taken over in our portfolio in the last year. Companies like Megit, Stock Spirits, HomeServe have had takeover bids, and that's led to very significant outperformance from those shares. So that stock selection has really driven the performance.
And given the sort of moves and deratings you've seen, what are the recent new additions and also sales to fund those that you've been making?
It's been a mix, as I said earlier, across both defensives and cyclical areas. So earlier in the year, we added a company like Unilever, which is a big consumer goods company, which had been heavily derated compared to the market, and at that point looked much better value. Yeah, so we've added some more cyclical companies as well. Businesses like CRH, which is a big building and materials company, the biggest in America and in Europe. Companies like we're quite interested in companies like National Express, which are beneficiaries of the reopening trade. So as the economy returns back to normal from the pandemic, activities like school buses and transportation should return to normal. So businesses that are exposed to that reopening trade are quite interesting. Within the mining sector, we switched. So in terms of sale, we sold BHP Billiton, switched that into Rio Tinto on relative valuation grounds. Other sales, there's actually been fewer sales from the portfolio. We've added a little bit to the number of holdings, but we have sold companies like Relex, the media business, which had a good re-rating, and the shares got towards full value in our view. We sold ITV, also another media company, where we had a change of our investment view. We're very disciplined in general. If we have an investment case on a stock and something changes, we will either sell the company or have to really be sure that we still want to own it. So there have been a few shares we've sold, but actually we probably bought more new companies than total sales this year.